Welcome, everyone. You're on the Smart Capital School of Financial Literacy channel. Today, we're diving into the 2026 financial landscape. We're specifically looking at the sweeping new tax policies, the ongoing tariff debates, and what all this data actually signals for your everyday investor.
Yeah, and there is just a massive amount of noise in the financial sector right now regarding all these new rules for capital allocation.
Oh, absolutely. So our objective today in this deep dive is to bypass those headlines, extract the actual data from the latest policy shifts, and map out what is mechanically happening with the economy in your portfolio.
It's a really important discussion, and before we get into the actual mechanics of it, we need to establish the framework of this analysis. We are going to be breaking down policies that originated from President Trump's administration, including the comprehensive tax overhauls enacted for 2026. But I want to be entirely clear here. This discussion is strictly about the mathematics, the historical data, and the market implications. We are not here to take political sides, debate ideology, or endorse any specific administration's viewpoints. We're just impartially looking at the numbers to understand the current financial reality.
Yeah, which is really the only way to genuinely understand the market. So let's start with a foundational shift that has dominated recent economic discourse. That's the proposal to replace the modern income tax system entirely with tariffs.
Right, which has been framed in the media as this novel, radical idea. But looking through the historical data, it's actually a return to the original funding mechanism of the United States.
Yeah, prior to the early 1900s, tariff revenue was the primary engine for federal operations.
What's really fascinating here is how the whole philosophy of taxation has inverted over the last century. When you look at the federal government's operational footprint prior to World War I, it was relatively minimal. I mean, they could afford to subsidize their functions almost entirely through import duties.
And the numbers from that era really highlight the contrast. When the income tax was officially ratified in 1913, the structure was almost unrecognizable by today's standards.
Oh, completely.
If you adjust for inflation to give us a modern equivalent, an individual would pay a 0% tax rate on their first $100,000 of earnings. From there, it was a mere 1%.
And the top tier is wild.
Right. The maximum top tier bracket was only 7%. And that didn't even kick in until you were making the inflation-adjusted equivalent of over $16 million a year.
It really illustrates a completely different relationship between capital and the state. But as the administrative state expanded throughout the 20th century and federal spending just scaled up exponentially, the government structurally shifted its dependency away from tariffs.
They became heavily reliant on the broad, consistent base of the income tax, which brings us directly to the 2025 tariffs clash. We saw an attempt to aggressively revert to that older model. Sweeping tariffs were passed on foreign imports, creating these immediate shockwaves through global supply chains and equity markets.
That's right, but the execution hit a hard legal wall. The Supreme Court ultimately struck down those sweeping 2025 tariffs, ruling them unconstitutional based on the specific legislative mechanisms used to enact them.
So they had to pivot.
Right. The administration's response was to pivot, proposing a baseline 15% global tariff using an entirely different legal framework. And the stated macroeconomic goal behind this 15% baseline was to generate enough revenue to offset and eventually replace the domestic income tax.
Okay, let's unpack this because the stated goal and the mathematical reality seem to be operating in two different universes.
They really do.
If we look at the hard data from 2025, the U.S. Treasury collected roughly $5.25 trillion in total tax revenue. That encompasses everything: income, payroll, corporate property, and tariffs.
But the federal outlay...
Exactly. The actual spending was around $7 trillion.
Yeah.
We were already operating at a deficit of nearly $2 trillion before any tax cuts or tariff shifts even entered the chat.
And if we isolate the specific revenue streams required for this proposed transition, the disparity becomes glaring. Out of that $5.25 trillion revenue pie, individual income taxes generated approximately $2.65 trillion. It is the undeniable anchor of federal funding.
Meanwhile, what was the yield from tariffs?
Tariffs brought in roughly $200 billion.
So we are looking at $2.65 trillion from income tax compared to just $200 billion from tariffs.
The math here is inflexible. You're looking at a revenue gap of more than a factor of 10. To fully replace the $2.65 trillion generated by the income tax, that baseline 15% global tariff wouldn't just need a slight bump.
It would have to go to the moon.
Theoretically, it would need to scale exponentially, somewhere in the neighborhood of 150% or more.
But doesn't a 150% tariff inherently break the model? I mean, if you tax imports at that level, foreign goods become too expensive for the domestic market, import volume plummets, and your tariff revenue actually drops to zero because the trade just stops entirely.
Exactly. It's the Laffer curve applied to international trade. At a certain threshold, the tax becomes prohibitive, trade halts, and revenue collapses. Therefore, practically speaking, an immediate one-to-one replacement of the income tax using the current global supply chain structure is just mathematically unfeasible.
Which explains why the income tax isn't going anywhere just yet. Instead of replacing it, Congress moved to aggressively modify it.
Right. They had a deadline coming up.
Yeah. The lower individual tax rates from the 2017 and 2018 legislation were slated to sunset on December 31st, 2025. Without intervention, we were looking at an automatic, across-the-board tax hike for almost every working professional.
Thank you for joining us. Let us know in the comments how you like this format of video analysis and what topics you'd like us to cover in future videos.
So to avert that fiscal cliff, the 2026 One Big Beautiful Bill Act was enacted, and it fundamentally altered the brackets.
Yeah.
The real story with these new brackets is how much further the middle tiers stretch. It creates this structural, earn more, pay the same dynamic.
Yes, the expansion is significant.
For instance, a single filer can now earn well over six figures, up to $105,000, before they ever touch the 22% tax rate.
Let's break those down. The 10% rate covers the first $12,400. The 12% rate extends all the way to $50,400. And as you mentioned, the 22% stretches to $105,000. It provides a substantial buffer for middle-income earners against inflation-driven wage increases. It prevents what we call bracket creep.
And it continues up the ladder. The 24% bracket now stretches to $211,000. Then it steps to 32% up to $256,000, 35% up to $640,000, and the top marginal rate of 37% only applies to income exceeding $640,606.
But those raw brackets only dictate the baseline.
Right, the real strategic shifts are hidden in the 6 major tax exemptions introduced for 2026.
The exemptions are where behavioral economics really come into play. Take the first one, the exemption on tip income. For individuals making under $150,000 a year, up to $25,000 in tips is now completely tax-free. However, the legislation explicitly sunsets this provision after 2028.
That sunset clause is critical. It essentially acts as a short-term stimulus for the service sector, but it's not a permanent structural change. The second exemption targets overtime pay. Single filers making under $150,000 can shield up to $12,500 of overtime income from taxes, and married couples making under $300,000 can shield up to $25,000.
Which raises a fascinating question about labor market dynamics. By making overtime significantly more lucrative on an after-tax basis, you incentivize the existing workforce to increase their hours.
Makes sense for the employee. What about the employer?
From a corporate perspective, employers might find it more tax efficient for their employees to authorize overtime rather than going through the frictional costs of hiring and training new fully taxed personnel.
That's a great point about how tax code dictates corporate hiring behavior. The third exemption, however, seems a bit more controversial regarding actual financial literacy.
The car loan one.
Yeah. There is a new provision allowing a deduction of up to $10,000 in car loan interest, provided the vehicle is assembled in the United States and the filer meets certain income caps. Under $100,000 single or $200,000 married.
This is a classic example of protectionist industrial policy embedded directly into the individual tax code. It's designed to stimulate domestic auto manufacturing. But to your point about financial literacy, it creates a real dilemma for the consumer. Does taking on a high-interest auto loan for a rapidly depreciating asset make sense just to chase a tax write-off?
It feels like a trap for the unwary. You might lower your taxable income by a few $1,000s, but you're paying a financial institution much more than that in interest. All while the asset loses 20% of its value the second you drive it off the lot. It's letting the tax tail wag the financial dog.
Precisely. It's crucial to evaluate the net worth impact, not just the tax return impact. Moving to the fourth change, we see an increase in the standard deduction. This is the baseline shield that applies to everyone who doesn't itemize. It's been raised from $14,600 to $15,750 for single filers and doubled for married couples.
That's essentially $31,500 of completely untaxed income for a married household right out of the gate. Combine that with the fifth provision, the senior bonus, and the shielding gets even stronger for older demographics.
Right.
Individuals over 65 making under $75,000 receive an additional $6,000 tax bonus, which phases out as income approaches $175,000.
These base-level deductions and bonuses act as a macroeconomic floor. By shielding that baseline income, the government is ensuring a certain level of sustained consumer spending, which keeps the broader retail and service economies liquid.
But not everyone is winning in this new code. The sixth major shift is a significant tightening for the corporate sector regarding business meals. The era of fully writing off client lunches, employee dinners, and corporate beverages is effectively over.
It's a major cultural shift for B2B sales and corporate expense accounts. Historically, those deductions artificially subsidize the high-end restaurant and hospitality industries. By removing the tax advantage, companies will likely tighten their internal expense policies, which forces capital to be deployed more efficiently rather than being spent on heavily subsidized entertainment.
That shift in corporate expense rules brings up a much larger point about how businesses are being treated overall. While they're losing the free lunches, they maintained a massive victory on the baseline corporate tax rate.
If we connect this to the bigger picture, maintaining that 21% corporate rate rather than letting it revert to 35% fundamentally shifts the calculus for capital allocation. When you're dealing with the classic double taxation model of a C corporation, that base rate is everything.
Just to ensure we're all on the same page regarding the mechanics of that, we are talking about the fact that a corporation pays taxes on its net income, and then the shareholders or owners pay a second round of taxes when that money is distributed as dividends, correct?
Exactly. If a company retains its earnings at a 21% tax rate rather than a 35% rate, it holds significantly more dry powder. Whether the executive board chooses to deploy that capital into research and development, aggressive hiring, or simply executing stock buybacks to artificially boost their share price depends entirely on the specific company's leadership.
And that leads directly to how the 2026 system treats the individual who owns those shares. The contrast between how the tax code treats wage earners versus how it treats capital allocators is stark.
The system is structurally designed to reward the deployment of capital over the trading of labor.
The 2026 investment tax brackets illustrate that perfectly. If your income is generated through long-term capital gains or qualified dividends, you pay 0% in taxes on gains up to $49,450.
0%.
Right. Once you cross that threshold, you only pay a 15% rate on investment income, all the way up to $545,000. And the maximum possible rate, regardless of how many millions you pull from the market, is hard capped at 20%.
When you compare a 20% maximum rate on capital gains to a 37% maximum rate on W-2 labor, the legislative intent is obvious. Furthermore, they are aggressively expanding the avenues for investors to grow that wealth entirely shielded from taxes.
The new contribution limits for 2026 are staggering. The standard IRA limit has been pushed to $7,500. The health savings account, which is arguably the most powerful skilled retirement account available, is up to $4,400. But the real institutional weight comes from the employer-sponsored plans.
Yes, the 401k contribution limit has been raised to $24,500. And for the self-employed or small business owners, the SEP IRA limit has been expanded to an incredible $72,000 annually.
By aggressively expanding these tax advantage limits, you're essentially guaranteeing a structural influx of institutional and retail capital into equities. Doesn't that level of forced automated buying provide massive underlying support for asset prices, almost regardless of broader economic headwinds?
It creates a powerful liquidity floor. Every 2 weeks, as payrolls are processed nationwide, billions of dollars are mechanically routed into target date funds, index funds, and large cap equities. When you expand the capacity of those funnels, you inherently increase the aggregate demand for equities. In a market where the supply of outstanding shares is often shrinking due to corporate buybacks, that sustained demand naturally drives valuations upward over the long term.
That historical context is vital because the instinct for many retail investors is to try and time their market entries based on what Washington is doing with the tax code. Does tax policy actually drive the market?
And that is exactly where a 50-year retrospective analysis proves invaluable. Over the last half-century of financial data, the United States has undergone 10 major structural tax changes. 6 of those were significant tax cuts, and 4 were major tax hikes.
Let's look at the cuts first, because conventional wisdom says lower taxes equal a higher stock market.
The data generally supports that. In 5 out of the 6 major tax cut periods, the broader equities market posted significant positive returns over the subsequent 12 to 24 months.
So what was the exception?
The solitary exception to this trend occurred in 2018. However, that specific downturn was driven less by the tax policy itself and more by severe concurrent disruptions in global trade and massive tariff implementations that spooked institutional investors.
So tax cuts broadly correlate with market growth. But what happens to portfolios when the government inevitably hikes taxes to cover those massive deficits we discussed earlier?
This is where the retail psychology often gets it wrong. In all four of the major tax hike periods over the last 50 years, the stock market also went up.
That seems entirely counterintuitive. If corporations and individuals have less capital because of higher taxes, how does the market keep climbing?
It comes down to macroeconomic timing. Governments typically only possess the political capital to implement severe tax hikes during periods of robust economic expansion. They raise taxes when the underlying economy is running hot enough to theoretically absorb the fiscal drag. Therefore, the momentum of the business cycle often overpowers the friction of the tax increase.
Wow.
The empirical takeaway for the investor is profound. The broader economic machine grinds forward regardless of the fiscal policy of the moment. Attempting to liquidate a portfolio based on legislative news cycles is statistically a losing game.
It fundamentally reinforces the necessity of being a long-term capital allocator. You have to tune out the political theater and focus on acquiring high-quality assets.
Speaking of tuning out the noise, there is a critical piece of monetary data from early 2026 that has gone largely unreported, and it completely alters the context of these tax cuts.
You are referring to the Federal Reserve's February liquidity operation. Exactly. While the public focus was entirely consumed by the debates over the new tax brackets and the Supreme Court tariff ruling, a quiet but massive intervention took place. On February 5th, 2026, the Treasury Department acknowledged that the Federal Reserve had injected $90 billion of newly created liquidity directly into the financial system to stabilize overnight lending markets. Furthermore, they indicated no immediate plans to taper this systemic support.
This mirrors the silent interventions we saw in the repo markets back in 2019. It reveals a stark divergence between fiscal policy and monetary policy. On the fiscal front, as we've detailed, the government is utilizing exemptions, extended brackets, and elevated contribution limits to lower your tax burden. They are ostensibly trying to leave more capital in the private sector.
But on the monetary front, the central bank is acting as the buyer of last resort, flooding the institutional plumbing with $90 billion of fresh liquidity just to maintain baseline stability.
This raises an important question, and it is the ultimate concept you need to evaluate as you structure your long-term portfolio. We have a system that is simultaneously reducing its revenue through tax cuts while requiring continuous multi-billion-dollar injections of newly created capital to prevent structural seizing.
Yeah.
If the baseline stability of the financial markets is increasingly dependent on the continuous expansion of the monetary base, what does that mathematical reality ultimately mean for the long-term purchasing power of the fiat dollars you are working so hard to accumulate?
That is the defining economic question of this decade. Navigating 2026 isn't just about understanding your tax bracket, it's about understanding the mechanics of the currency itself. Thank you for watching this video to the end. Subscribe to the channel, like it, and see you in the next retelling.